From New York City, for our viewers worldwide, I'm Katie Greifeld in for Jonathan Farrow. Bloomberg Real Yield starts right now. Coming up, inflation expectations falling, investors jumping back into junk bonds, and all as 2023 quickly approaches. We begin with the big issue, Fed minutes out in about an hour, but investors looking beyond December.
The markets are really focusing on the fact that the Fed's likely to decelerate the pace of hikes.
We're looking for 50 basis points in December.
Another 50 basis points.
50 for December.
Focusing less on the promise of more hikes into the future and maybe a higher terminal rate.
Waiting for that moment when the Fed is likely to pivot. Are we there yet? Are we there yet? Are we there yet?
We think they're about 70 to 80% done with the tightening cycle.
They're pushing back against the easing in financial conditions.
Keenly focused on the labor market.
Now more than ever is about growth.
They are going into restrictive territory. It doesn't matter what they say, because that is going to continue damaging growth.
We worry about the Fed or other central banks going a bit too far.
The Fed see a greater risk reward in over tightening. That's still going to go hand in hand with considerable market volatility as investors are looking for guidance.
Joining us now, Academy's Tchir, VanEck's Fran, Rodilosso, and Cameron Dawson of NewEdge. Cameron, let's start with you, because we do get minutes from this month's FOMC meeting in just about an hour. Is there anything that we could learn at 2 p.m. that would change your base case?
Well, I think it's less of a question of what they do in December, because 50 basis points is very well telegraphed and priced in. It's then a real question about how much higher that terminal rate will be. Powell signaled to us back at the November meeting that to expect the terminal rate to be higher than the 4.75 that was in the September SEP. So how much higher above 5%, because that's what the market is pricing in right now, will we see that terminal rate go? And there's likely still going to be a discussion about wanting to keep rates in that restrictive territory for some time. So it'll be interesting to see how much the bond market reacts to that, simply because there still are cuts priced into the back half of next year.
And Peter, you just heard it from Cameron, 50 basis points, it's priced in for next month. But if they do deliver 50 basis points, does that change your expectations for the rest of the trajectory of the Fed's path here?
Not really. I think a few weeks ago, the market was thinking it could be 75. I think the data's coming in weak. We saw weak PMIs. We still have 3 more weeks ahead of the December. I'm sure they do 50, but I think if anything, the data will tell them not to do 50. I think the market's starting to diverge from any amount of hawkishness the Fed can say, because we're all starting to realize recession's probably the base case. And I think a lot of people are coming to the direction I've been all along, which the recession's going to start sooner and be deeper. And that's just going to take all the Fed job owning off the table.
So the recession is your base case as well. Fran, let's turn to you, because for so long, the rallying cry was that the Fed was going to go higher and hold it for longer. But if a recession is on the way, in your view, does that shorten the period of time between the Fed's last rate hike and its first rate cut?
It would, for sure, depending upon the depth of a recession. And if Peter's correct, then they will be having to actually pivot. Our base case has been for more of a pause middle of next year. What makes me nervous about that base case is that seems to be what the market is pricing in, at least for a few months, which is inevitably wrong. So obviously there's going to be a lot of data between now and then. I think the Fed may be in a very, very difficult spot next year, because although inflation data is getting softer along with economic data, there are still some signs that parts of the inflation story are going to remain persistent for some time.
So, Cameron, as we talk about the depth of a potential recession here, let's talk about the depth of the inversion that we're seeing in a variety of yield curves right now, whether it's the 3-month 10-year, the 2s, 10s, pick your curve, really. But we're at the most inverted levels in decades. Does the magnitude of that inversion say anything to you?
It's certainly important because it's a big flashing yellow light that there is economic weakness at some point on the horizon. The problem is the depth of the inversion doesn't really tell us much about the timing of the economic weakness. And we have seen pockets of better growth in recent data. So Atlanta Fed GDP now is still tracking at 4.2% for the fourth quarter. So we think instead of looking at just the depth of the inversion for the yield curve, it really is a matter of when it starts to re-steepen, because that's the signal, the flashing red light, that we are in an imminent recession. And that's likely because the short end of the curve starts to rally and starts to really price in rate cuts in that 3-month, in that 2-year part of the curve.
And so that re-steepening, I mean, what is the bigger movement in there? Is that coming from the short end, the two-year tenor, or is that more the long end moving?
It's likely going to come from the short end when we see the re-steepening. That's what typically happens right before recessions. And that is actually also what happens before you see bottoms in risk assets. So before you see bottoms in credit and in equities, is you see that re-steepening. And it happens because the bond market starts seeing true weakness, acute weakness within the economy. It expects the Fed to start to cut rates. And that's when you just start to see real weakness within corporate profits that do affect those risk assets. So we really look to the short end of the curve to be our guide to tell us the timing of the recession.
So, Fran, more movement there potentially at the short end when you think about a potential re-steepening of this deeply inverted yield curve. But let's talk about the long end for a little bit, because Bloomberg's Liz McCormick had a great interview with the chief rate strategist over at Goldman Sachs. The view was that inflation will remain somewhat above the Fed's target over the next few years. So our yield forecasts are also a reflection of our view that inflation will be somewhat structurally higher. This cycle is different, not like those that we've seen in the last 30 years. And what really caught my eye was this call that the 10-year Treasury yield will stay at 4% or above through 2024. Quite a big call. Do you agree with that? Do we have 4% Treasury yields in our future for much longer?
I actually do agree with that. I don't think that's bad news, however. I think the scenarios where we're going closer to 3% 10-year Treasuries would be a lot worse news economically, in all likelihood. A couple of other things are going on we need to remember. The Fed still owns about 25% of the Treasury market. So there's another part of monetary tightening going on, QT. And so balance sheet reduction is also going to have an impact on the entire yield curve. So that factors in. But it's been VanEck's assumption all along that inflation is going to remain more persistent than the market would like. And we're listening to the Fed on that count as well. That is why they remain committed to the hikes so far. So, yeah, I mean, 10-year break-evens, if you look at tips versus treasuries, are pretty optimistic. So are even 2-year break-evens. They're pretty optimistic in terms of inflation coming down. We don't think that is in the most likely category.
Peter, let's talk about what this means for volatility. If we do have structurally higher inflation, if we do have structurally higher long-end Treasury yields, obviously the MOVE index of Treasury volatility has been very elevated this year, climbing all year. You compare that to what's happening in the stock market. This is one of the biggest market mysteries for me, why we aren't seeing stock volatility. On a cross-asset level, how do those two measures of volatility come back together? Do you think bond volatility comes down here, or do you think that it will eventually drag the VIX higher?
I do think we'll see bond volatility come down a little bit. A lot of the issues in the bond market we're starting to deal with. You're starting to see even mortgage prices stabilize, right? So mortgage yields actually had a good rally. I do think, though, we are in for a little bit more pain, I think, for a lot of people, that we're going to see probably 350 on 10s before we see 4. Back when it was above 4.1, I like 370. I think he keeps going down. I think we are going to see this flattening of the yield curve. And I think from a stock standpoint, we are going to shift fairly soon. And it's not as much about the volatility, but the level of yields. And for now, stocks have been, oh, yields are lower. That is a good thing. I think the big shift is going to become when people realize yields are going lower because the bond market's seeing economic problems, and that's going to weigh on stocks. And that might be the signal that kind of flips that yield curve, and maybe that's what triggers the 2-year and gets those other signals saying the bottom's in. So I think we don't see the bottoms on stocks until we get a traditional risk-off rally. lower treasury yields, lower stock prices.
Yeah, in a way, I mean, it's the same call. If you have the ceiling on yields, perhaps you have the bottom in stocks. But it's very aware to me that tomorrow is Thanksgiving. So I want to get a little bit cute here, Peter. If you look at the economic data that has been coming through, if you look at market-based expectations of inflation, about where the Fed is going, what would you say that central bankers are thankful for this year?
Oh, wow. That they allowed to keep their jobs when they got it so wrong last year?
Okay, that's a pretty good one. Fran, what do you think?
I was going to say the same. They're happy to still be employed. They're probably also happy that there is some sign of softening inflation and that they don't have to keep the 75 pace in December, or else they might not have a very Merry Christmas.
Central bankers and weathermen, they do get to keep their job. But Cameron, just on that last month note there, we are heading into the holiday period. What do you think is on the Fed's wish list as we sort of count down to that?
Well, they certainly want to see some of those pandemic-related parts of inflation continue to decelerate. We started the year with durable goods inflation running at almost 20%. It slowed to about 5% now, and that really is that transitory part of inflation that has come out of the system because supply chains are healing. But as demand has remained so robust, and if we have a strong holiday spending season, does it cause these supply chains to be caught flat-footed again? And do we see a kind of acceleration in that durable goods inflation? It's a question for 2023, just given the fact that retail sales and overall consumer demand has remained so resilient.
All right, well, you guys are all very good sports. I'm glad that you're all sticking with me. Peter Tchir, Fran Rodilosso, and Cameron Dawson. Everyone sticking with us. Up next, it's the auction block. A slow week for U.S. issuance during this Thanksgiving week, but some big macro trends. Details next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where we have a holiday shortened week here in the U.S. that brought just $6 billion in high-grade issuance. Now, with that low level of issuance, we're going to take a more macro view this week. In Europe, multiple central bank rate hikes this year have pushed borrowing costs towards the highest level in a decade. The result is that bonds sold this month by investment-grade issuers have an average tenor of about 6 years. That is the lowest since December 2018. And looking at European junk bond sales, issuers on the sidelines as investors demand sky-high premiums. Sales are down 80% from the same time last year and have accounted for just 1.9% of total issuance volume since the start of the month. And turning to sovereigns here in the U.S., as of last Friday, around $13.5 trillion worth of bonds have been sold this year. That puts issuance down 14% compared to the same period last year. When it comes to high yield, a rally in U.S. junk is being bolstered by flows into junk bond funds. The sector saw an estimated cash intake of $2.4 billion between Thursday and Monday, putting the week on track to be the 5th consecutive with inflows. Now, as you might imagine, the two big U.S. high-yield ETFs are seeing a second straight month of inflows. Peter Tchir, Fran Rodilosso, and Cameron Dawson are back with us. Fran, I want to start with you on that point that you've seen this really enthusiastic jump into those junk bond funds, both mutual funds and ETFs. Do you think that now is the entry point for that market?
I think now is an interesting entry point. High yield has come back in now to around 8.5%, closer to 8.5%, sort of weighted average yield to worst. It was over 9% last month, which even from an historical perspective is actually quite attractive. It's roughly what high yield was yielding for the decade prior to the global financial crisis, before we entered this period of unprecedented monetary policy. Also, new issuance has been extremely low. Net new issuance, almost nothing in a high yield market this year. Corporate fundamentals from a static point of view look solid. Obviously, there could be a lot of changes in the earnings pictures over the next 6 to 12 months. but for all those reasons, namely the current yield carry, which could really be enough to absorb about a couple hundred basis points in either higher rates, higher credit spreads, or some combination thereof. So carry that we haven't seen in really more than a decade is playing what it should play, a really, really big role, the most important role in bond returns. That's why investors are coming to high yield. With ETFs, there's also always some technicals, though, big hedging instruments. It could be related to option strategies. So flows to ETFs are not always indicative of market sentiment, but in this case, they probably are.
Definitely a good sense check on those ETF flows. They are very actively used as trading vehicles. There's a great show on ETFs, actually, 1 p.m. Eastern on Mondays. Really killer anchor. But Cameron, let's go to you because Fran raises a good point, sort of the idea of you have very attractive yields at this point, but one of the biggest reasons why you've seen so much spread widening this year is because of that duration risk, that interest rate risk. And I see in your notes that you expect spreads to widen more from here. Is that more of that interest rate risk, or are you getting a little bit nervous on the fundamentals here?
Yeah, it's more about corporate profits from here, because if we think that a recession could start at some time in 2023, even if it's later 2023, you would expect corporate profits to come under pressure, corporate margins to come under pressure, which should then impact credit fundamentals, meaning that though we have seen this rally back into risk, and there's been many examples of some pretty ravenous risk taking throughout the market, whether it's flows into high yield ETFs, flows into equities being nearly double what we saw in the prior equity rallies earlier this year. So people are definitely chasing into year end. But once we get into 2023 and we look at those corporate profit fundamentals, we do expect to see some deterioration, which would warrant some spread widening. Now, of course, we'll have to weigh that with the supply demand, because as we've been talking about, there still is just demand to lock in yields that are higher than what we've seen in decades. So if you can be a long-term investor, ride it out until maturity, maybe you're not as sensitive to the near-term credit fundamentals, but we do expect widening.
Peter, like Cameron just said, there's been some really ravenous risk-taking going on, especially in the bond market. Where do you fall right now in the debate between investment grade and high yield? What's the more attractive asset class there?
It's a tricky one. So I think on an outright yield basis or total return basis, I think high yield still has a little bit room to outperform, right? You'll get this move in yields. I think spreads are going to be okay. And as Francis said, you are currently getting paid for taking that risk. So you get yield. The path to hell is always paved with carry, but I think for now you can live with that. Having said that, I think if you're looking at a relative value on a spread basis, you want to own investment grade on spread rather than high yield. I always compare high yield to the Russell 2000, investment grade to the S&P 500 when I'm thinking about rel val, and I think you're going to see equities underperform. So if you're able to own spreads versus equities, I think that trade's interesting. If you have to own spreads outright, I think you can be a little bit cautious here because we probably see a little spread widening into year end.
All right. Cautious on spreads outright. I do want to bring you guys this quote from T. Rowe Price. This caught my eye, that there's a risk of over-tightening until the time the Fed is done. You short duration, and I'm actively positioned that way. And Fran, I want to bring that to you, not so much the risk of over-tightening, but the idea of short duration. Do you agree? Do you just sit on the short end here, or is it time to add back duration?
That really depends upon, your view on the economy. And for investors who see the risk of a deeper recession, duration is one of those facets of fixed income that provides a hedge against equity returns. Now that we are in a more normalized fixed income environment where you actually have positive non-zero yields, maybe not positive real yields quite yet, duration can play a role. However, there is some attraction to the short end of the curve. Getting 4.5% on T-bills or higher is compared to what we've seen the last decade. It's low credit risk, low duration risk. Even if recession is likely, or at least a slowdown next year is quite likely, there is a wide range of potential scenarios. And so even duration can be a risk in this market, particularly with the inflation story not completely told. But yeah, the short end, and I agree with Peter as well, like there's a good argument for staying higher quality. You can get yield now in fixed income for the first time in a decade without taking excessive duration risk or excessive credit risk.
Cameron, quickly, we only have about 30 seconds here, but something that's unusual so far about this cycle is that we really haven't seen that wave of downgrades, that wave of defaults that usually comes in a downturn. Do you think that's next?
It is next, but it's going to take time. It usually lags. Usually we see defaults peak well after the peak in spreads. So we would expect downgrades, we would expect defaults to come, but just in time, meaning that it's likely more of a late 2023, more an early 2024 event.
Just in time defaults. Peter Tchir, Fran Rodilosso, and Cameron Dawson, everyone sticking with us. Still ahead, it's the final spread. The week ahead, we'll hear from major central bank leaders after the holiday weekend in America. More on that next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. It's time now for the final spread the week ahead. Coming up, U.S. markets closed for the Thanksgiving holiday, but we get a host of global central bank decisions on Thursday. U.S. markets are closing early on Black Friday, but we do get ECB President Lagarde and BOE Governor Bailey speaking on Monday. We'll hear from Fed Chair Jay Powell on Wednesday, followed by U.S. economic data, including GDP. But first, it's time now for the rapid fire round. 3 questions, 3 quick answers. Cameron, I want to start with you because junk spreads right now, they're at 440 basis points currently. Do we see 400 or 600 first?
We see 400 first, and then we go to 600 in 2023.
Fran.
600.
Peter.
I'm going to go with 400 first.
Cameron, does the Fed cut rates in 2023?
Very back end.
Peter.
Possibly back end.
Fran.
No.
Last question, Cameron, does quantitative tightening last through the end of 2023?
Yes.
Peter.
Yes.
Fran.
Yes.
All right, guys, great job. My thanks to Peter Tchir, Fran Rodilosso, and Cameron Dawson. That is going to do it for us today from New York. Same time, different day last week. We're actually going to be back on Friday, so look forward to that. This was Bloomberg Real Yield, and this is Bloomberg.